Hello guys, welcome to Kho Academy. Guys, in this video, we'll be talking about closing entries. It's the last part of the accounting cycle, and let's dig deep into it. Okay, so closing entries are journal entries made to close the balances in the temporary capital accounts and to transfer the net income or net loss for the period to the capital accounts. So what are temporary capital accounts? These are expense accounts and income accounts. So income account and expense accounts for a particular accounting period. Let's suppose 1 year. We will suppose in our case they are closed out at the end, and their balances are shifted to the balance sheet. As you can see that in the balance sheet we add the net profit for the year or deduct the net loss for the year. So these entries are called closing entries. So after journalizing closing entries, the accounting cycle is almost complete. Remember what consisted accounting cycle? Accounting cycle started with collecting and verifying the source documents. Then when we analyzed each transaction, then we journalized those transactions in the books of accounts, like in the sales day book, in the purchases day book, in the cash book. Then we posted those transactions to the ledger. Then we prepared a trial balance, and afterwards we prepared a worksheet. Then we prepared financial statements, and then we journalize and post the closing entries, and after that we prepare a post closing trial balance. So let's move on. So the purpose of closing entries. This is the income statement. As you can see, it starts with revenue, and then all the expenses are deducted, and then after we subtract the expenses from the revenue, we come at net income. And this is the statement of changes in owner's equity, and it starts with the opening capital. Then you add the investments made by the owner during the year, and then you add the income statement, and that gives you the total increase in capital. Then you subtract the drawings, and that gives you the ending capital balance. Talking about balance sheet, as you can see that all of the assets are listed. Then the lower portion of the balance sheet consists of liabilities and equity, and that liabilities and equity make the total liabilities and owner's equity section. So though of course, since in double entry both the sections must balance. So the net income appears on the income statement as we just discussed. As you can see, the yellow highlighted portion, net income is included in the ending capital balance. Okay, as you can see that in the statement of changes in owner's equity, the net income of 1150 is included in the ending capital balance. Ending capital balance was 26050, and opening was 25400. Now opening balance, it includes 1150 of net income. So essentially you take the net income figure and you post it in the statement of changes in equity, as you can see the yellow one. So an ending capital balance goes to the balance sheet, where you can see in the yellow one, where you can see Maria's capital. Now that includes this balance sheet. This includes ending capital balance. So see, revenues and expenses, they are posted in the income statement, and they form the net income. Net income is posted in statement of changes in owner's equity, and from there it goes to the balance sheet. So this capital balance does not match the capital balance in the general ledger. Why, we will discuss. So the income summary account. Okay, it's about time that we start using this account. uh, and how do we use this income summary account? Well, income summary account is used to accumulate and summarize the revenue and the expenses for the accounting period. So it's essentially an income statement, profit and loss account, what we're talking about. So it's nothing new. Okay, this post closing journal entries, it's nothing new. You know everything, but don't get confused with the term. So income summary is a simple version of the income statement for the year. Okay, revenue goes in as a credit and expenses go in as debits. Just you studied about this earlier. The balance of the income summary is the net income or net loss for the accounting period. Okay, so as you can see here, the T account, the debits and credits, revenue goes on the credit side and expenses go on the debit side. And the difference, if it's a credit balance, then it means that you have got a net income. Okay, Credit balance means that your revenues were higher and your expenses were lower. So credit balance means that you earned a profit for the year, and debit balance means that you incurred a loss. So quick summary of closing entries. The balance of the revenue account is transferred to the income summary. The expense balances are transferred to the income summary, and the balance of the income summary is transferred to capital account. And what was the balance of income summary? It was net profit or net loss. And the balance of the withdrawals is transferred to the capital account. So withdrawals, that is drawings, as well as profit or loss which you made for the year, they are transferred to the capital account. So now it's your turn to solve a problem, and let's see how much you know. So the summary is that you transfer all the expenses and revenues into the profit and loss account, and from there they go profit or loss, whatever it is, it goes to the statement of changes in equity, and then that closing balance of the capital goes to the balance sheet. That's it for now. Thanks for watching.